Hi. I started this channel about credit cards, how to maximize your points and your rewards that you get back. And then, like many others I've seen over the last couple months, or at least the last year, that economic circumstances have changed greatly. And we keep seeing articles about, like this particular one here, about the fact that credit card delinquencies are on the rise. And most importantly, I started a little bit of a shift to help people figure out how to get out of debt and how to get out of debt quickly. And then all the things that come along with that, creating budgets, you name it. And then tricks and things to move to lower interest rate cards or loans or whatever it may be to facilitate and really speed up the paying off of your debt. And this is an article that came out, it was actually last year in November, but it's because the New York Fed puts out quarterly reports. So it was the third quarter of last year. If you're not familiar, quarterly reports, so first quarter would be January, February, March, second quarter, April, May, June, then July, August, September would be the third quarter. And of course, October, November, December, the fourth quarter. So they look at this quarterly. And they talk about, as you can see here, credit card balances growing $48 billion in the quarter. Overall, I've seen other reports, the total credit card debt for Americans, or those in the U.S., is over $1 trillion, which is astronomical. It's gone up at an incredible rate, which is not good for households. What's interesting, and so I'm going to do two things on a show regularly, either weekly or bi-weekly, and that is go over all the different credit card rates, personal loan rates, interest rates, car rates, and what the current rate environment is. And then you can use the different videos I've got to help you get out of debt. But things are changing fairly quickly because of the changes that the Fed has made in terms of just rates overall. Well, they don't make the rates, but they make the overnight lending rates to the banks. And then, of course, the banks, or those you're getting the loans from, set the actual rate. So here we go. It says share of newly delinquent credit card users rose in the third quarter and exceeds the pre-pandemic average. So back in 21, even in 19, 17, you can see it's gone up significantly here. It's up to almost 2%. So 2 out of every 100 people that have a credit card are delinquent. That means behind, I believe it's 30 days, 90 days. As you go down here, what's also interesting is they show you delinquency by generation. Generation Z being the youngest, they're the most delinquent at over 3%. And then you've got millennials, Generation X, baby boomers. So baby boomers are only about 1 out of 100. Generation X looks like it's 2 out of 100. And the millennials and Gen Z is almost 3 out of every 100. To me, that's extremely high. And then, of course, if you look at it by income levels, you can see that here the highest income has the lowest delinquency, and the lowest income has the highest delinquency. So that's really no surprise, and obviously that's why when you go to get a credit card, they look at various factors such as your past history, and they also look at your income levels because that can be telling as well. And then they talk about those with the largest credit card balances were the most likely to fall behind. So they show people that have over 20,000 total in credit card balances, it's almost 3 to 4 out of every 100 people are behind on their payments. So this doesn't bode well for the economy in general. But the reason I'm going to do the show and these episodes and get into the credit cards and the personal loans, mortgage, etc., is to give you an idea of the rates before you go buy anything. I think overall, all the economic indicators I've seen in the people that I watch and follow that get into more of the economics of the economy, things generally are overpriced. I don't think that would surprise you. This is 2024 when I'm making this episode in early January. Housing seems out of control. The affordability index is through the roof. Cars have gone up, etc. So let's get into it and look at first credit cards. Now, when you watch my other videos about getting out of debt, you'll see the common theme, which is pretty obvious, is try to tackle your highest interest rate loans, if you will, or I should say cards, whatever they may be, first, because they have the most amount going to interest, and the faster you can pay those down, then the faster you can accelerate the rest. So take a look at this when it comes to credit card rates. This is Investopedia, and I'll use sort of the same resources every episode to keep it, looking apples to apples, if you will. They say that Investopedia tracks all types of credit cards, and they have their own here. They call it their median average rate, at 24%. So the average credit card they see is a 24% rate. That's just astronomical. And at minimum payments, that's like paying it off in 10 years or possibly not even at all. The Federal Reserve, they have their own average, but apparently they don't look at as many cards, and they look at the lower end of the bank range. Because as you know, the banks can charge anywhere from X to Y, 20 to 30%, whatever it may be. And they say it's 22%. Regardless, it's extremely high. All right, now let's look at personal loans. Now, if you're familiar with these different types of loans, people always talk about personal loans and they'll say, well, just get a personal loan and consolidate all your credit card debt. Well, easier said than done. Why is that? Well, if you get a mortgage and you don't make your payments, the bank will, or the lender will go through procedure with a court system and they will take your house. If you have a car loan, they could literally come to your house, back up a truck, tow truck, and take the car. Credit card, well, there's no collateral. So the house and the car are considered collateral, something they can easily take to pay off the loan, or at least a portion of it. With credit cards, there's no collateral. With a personal loan, there's no collateral. So with a personal loan, they're harder to get because they're going to say, well, what's your income level, what's your debt to income ratio, all these things, and they're not easy to get. But it's a common thing that people talk about when they say, hey, let's just grab a personal loan. Now, what are those rates? Now, here it's interesting. They say, and they talk about, this was in January 8th was the article of 2024. Average overall rate, last week versus this week, they haven't changed much, just over 20%. The low being 10, the high being 30. So they can range 10 to 30%. The average is 20. Why would I show you something like this? Well, it's always good to know if you're going out and you're trying to get something like a personal loan, what kind of a rate are you going to pay? Well, if someone's offering you a 20% rate, and then they may have fees with getting the loan, origination fees, all kinds of other fees. If you've got a credit card at 20% and you got a personal loan at 20%, you're not really going to save anything. Why bother? Now, if you can get one at 10%, okay, well, that's different. That will help you get rid of it faster, and it might be spread out in such a way that you can make larger payments. Or I should say you can at least make the payments. Then what's interesting, if you scroll down, I'm going to put all these links in the description, but they've got the average personal loan rate by credit score. So this is why you want to keep a good credit score, and this is why you don't want to be one of those individuals that's going delinquent, because it will affect your credit score. Look at the difference. They say this week's average APR for excellent credit, for good credit, average APR from last week, the minimum and the maximum. So I would just look at the minimum and the maximum. Excellent credit, you can get as low as 9.3%. So let's just call it 10%. But then if you get down to fair credit, which still isn't horrible, and you get or poor, you're looking at 20 and over 19% and over 20%. So the difference can be significant based on your credit scores. You want to keep those up. Now, if you look here at the average personal loan rates, this is always good to give you an idea of what people are doing. They're saying that the average, look at the difference between April of 23 being around 19% to 20%, all the way to over 23%. So in less than a year, these personal loan average rates have jumped 4%, which is significant. Next, let's look at car loans. You may be looking at potentially purchasing a car. Well, before you go out and get a car, we'll get into prices in general. Just like everything else, there's huge inflation. And cars have been very expensive because of supply chain issues and all these other things. Regardless, they're quite expensive. So here are the loans. Now, this is Edmunds, and they track used vehicle rates, and they're looking at, December of last year, 11.4%. It's gone up. New vehicle rates, they're at 7%. Now, of course, you can go to a dealer and you might get a 24-month rate, a 36 or 48, and they might be offering you better rates like 2, 3, or 4%. But don't just look at the interest rate and the payment. That's sort of the car dealer trick. Don't worry about the payment. Worry about first the price. You want to get the best price you can. From what I've seen, it looks like cars are still very expensive. If you could, I would think you'd probably want to hold off on doing something like that. But you could potentially refinance the car that you have. I've got a video on that. If you've got a 30% credit card and you just need a couple $1,000s to pay it off, and you've got a used car, which is almost paid off, you can always refinance that car. If you could get a used car of 11%, that's not great. Maybe with better credit, you could get cheaper, but it's still better than 30%. So you refinance your car, get a little extra money. If there's some value there, meaning the car is worth more than you're financing it for, then you might be able to get some equity out of the car, just like you would get equity out of a home, and pay that down. Best to get 0% with a balance transfer if you could, but there's other things you might have to do if you can't do that. All right, so in general, there are 7 to 11% for car loans now. Now, here's what's interesting. I like this economic data from Fred here. Everyone shows these, but this is fascinating. New auto loans, 60-month loans on new cars, what do they average? Well, 2016, 17, 18, it was around 5%, 4 to 5%, 4.5%. Then COVID, if you will, it looks like it was 5.5%. Came down a little bit, but this, within the 2022 and 2023, look how it shot up. And it's sitting at 8% for a new car loan. Look at the difference in the percentage rate. So right now, if you go out to get a new car or a used car, and you think that prices are high, personally I think they are, so you're paying a high price for the car and you're getting a high interest rate, I'm not sure that makes any sense if you can avoid it at the moment. Average amount financed, I also found this very interesting. This isn't the average amount, this isn't the average price of a new car, but it says new cars at finance companies. What is the average amount financed? So let's just assume that everyone's putting the same percentage down on the car. Maybe it's nothing. Maybe it's 1,000, maybe it's 2,000, maybe it's just 10% of value. I don't know. But this is how much they've been getting loans for, how much of the value. So 2014, for quite a while there, for about 5 years or so, it was around $25,000. Then it starts creeping up, and then right before the pandemic, we're at 28, 29,000. Then all of a sudden it shoots up, and look where it is today. We're at 38, and recently we were at 40. So in less than 10 years, and particularly just in the last 3 years, it's gone from 31 and it peaked at 40. That's $10,000 from 30. That's significant. That's a 30% increase. So assuming the amount of loans that people are taking out on their cars is indicative of the price of the cars, the price of the average car has skyrocketed. So with high rates and high prices, it doesn't look like buying a car is the thing to do at the moment. Those were new cars. Now, Car Gurus is a site that sells, you've probably seen it, sells used cars. Well, they don't sell used cars. You can list your car for sale. They just provide the service. They have the coolest tool, I think, when it comes to used cars. I always like to do research before I get a loan, before I buy a vehicle, before I buy a house. I think everybody does, right? So this is a great place to look at used car prices. And you can put in dates here. I've already put in back to 2018. So it's that 5-year period of time to get an idea. And let me just get rid of all of these. You can see here, and I'll have this link in the description, the general Car Guru Index, they call it. Look at this line here. This is about 23,000. There's 21, 24. It's around 22. And it was cruising 18, 19, 2019, 2020. Then all of a sudden, 2020, it goes up about 1,000. But right around middle of 21, look how it shoots up from about 23,000 to well over 30,000, almost like 35,000. So just over 20,000 to mid 30s. Good grief, what, 10,000 on 20? That's a 50% increase in used car prices. That's astronomical. If I had a used car that I didn't need at the moment, I would be selling it. Even now, it looks like it's sitting around 28,000, which is still way more than, this 22. That's 6 on 20. Still like 25, 30% price increase. So used cars in general are very expensive. But then if you want to get an idea, this is really cool. I like cars, so I like looking at this, but you can break it down by type of car. So if you are trying to get your significant other to, maybe you have to purchase a car and you're trying to figure out what you all want to buy and you're trying to convince them of one thing over the other, check this out. I happen to already go through these, but you say, all right, what is a crossover cost? Average price of a car crossover. Now, this is the average price of a crossover car listed for sale on Car Gurus. So that doesn't mean that this is the average of all used cars, but it's a pretty large site, has a lot of inventory, so it's a decent barometer. Look at it from the 20s, it was in the about 20,000, 2020, now they're around 24. But what's interesting is if you have to buy a car, at least you can go through here and you can say, well, there's a crossover. How does that compare to an SUV? We'll check that out. This blue line here is the SUV, average price, and then the black line there is the crossover average price. So the SUV average price, if I can increase this here, 24,000, and then you can see this one here, crossover. Oh, the crossover is 24, and the pickup is that 35? Good grief. The difference between a crossover, and an SUV is $10,000. That's significant. And then you can click through here and look at the different types. Maybe you've got a bunch of kids, or even if you don't, I like looking at this one. The minivan. I clicked all these already. The minivan is by far the cheapest thing you're going to get. Generally speaking, 21, 22,000. Minivans are great. I love them. Toyotas, Hondas, you name it, any brand. You can do anything with them, and they're the cheapest thing you're going to get. And if you can convince your significant other to throw the kids in a convertible, you're going to be paying more than an SUV. And then what you can do, of course, you get rid of these guys. What is also interesting is you can come down here and you can look at makes. So you can say the basic. Let's look at a Honda, and then let's look at a Toyota. Not a really fair comparison because some of them might have expensive cars, and some may not have expensive cars. Toyota may have something like what do they have? Supras, and those are more expensive than probably your average Honda. So anyway, if you look at the average price, it's going to say, okay, the average Toyota is 25 used and the average Honda is 21 used. It gives you an idea. Anyway, this is always good if you're looking at used cars. So you can look here, and again, I'll put the link so you can see. It'd be nice if this is trending down. In other words, new car prices are going down. If you've got a used car, you can see they show you average price last 30 days, last 90 days, year over year. Year over year, it's going down 3%, the average car. Last 30 days, 1%. I still think cars are overpriced myself, but that's just me. Now, lastly, let's look at the fourth category here, and this would be mortgage loans. I just hop onto Google, and I throw it in there, and you can see they have a basic loan amount. You can change that, down payment, but apples to apples, let's just leave in what they've got. They have kind of a middle-of-the-road credit score. You're going to get a better rate with a higher credit score, obviously. Maybe even a larger down payment sometimes can get you a better rate. Loan amount can change it, but here you go. Apples to apples, I'll use this every episode. 30-year fixed, 7.5%. It wasn't that long ago things were at 3 and 2.5%, and we may never see those rates again in our lifetime, or in my lifetime, because my lifetime is probably much shorter than your lifetime, because I'm old. But 7.5%. They've gone down a little bit from the last month, but right now, houses, in my opinion, from what I've seen on the home affordability index, meaning how much of your income do you spend on something like a mortgage, houses are incredibly expensive. It appears that it's much cheaper to rent at the moment. So if you don't have to do this, don't do it. So just to recap, when I talk about the various types of loans, and of course a credit card is not a loan because you're able to draw down, pay it back, draw down, pay it back. So it's not like an installment loan where you've got 24 months to pay $200 a month and then you're done type thing. The highest rate was the credit cards at 24% on average. The personal loans were 10 to 20%, depending upon your credit score. Auto loans, again, depends on your credit score, also used versus new. New being around 7%, used being around 11%, and then mortgages at 7.5%. So in your journey to get rid of debt, keep those rates in mind before you go and get yet another card or a personal loan. And watch some of my videos. It's interesting ways in which you can use balance transfer cards to help pay off your debt quicker, ways that you can use credit cards that have bonuses or that sort of thing, ways that you can transfer from a high rate card to a lower rate card without paying fees, things like that. And at least in this current environment, it appears as though if you can keep from buying new stuff at the moment, and you don't have to, particularly on credit or on loans, it might be a good idea to kind of stay away from that. But we'll watch rates and where they go to give you an idea. Thanks for watching, and I hope to be doing one of these on rates and every week or at least bi-weekly. Thanks again for watching.